In today's video, I'm going to help you understand how dividends can make you passive income. We'll cover the logistics of how to use them for your advantage, also some red flags to be aware of, and when you really should not be using them. If all of that is what you're here for, then keep on watching. All right, let's get into what a dividend even is. A dividend is payment received by a company to a shareholder, so a person holding the stock or owning the stock. Companies pay dividends, and it's just another way of saying cash, like they just give you money for being a shareholder. The reason they do this is because typically dividend paying stocks, especially higher paying dividend stocks, they might not be focused on growth. They might just be focused on maintaining what they've already grown to. So instead of taking that money that they earn from their revenue and profits and reinvesting it into the company for growth, they turn around and give that to people that own their stock, which helps incentivize stockholders to keep the stock instead of owning a stock that's more focused on growth. So growth stocks are ones that typically don't pay dividends. They're the big names like Google, Amazon. They're those companies that are typically focused on some rapid growth, and they just take their profits and just keep reinvesting into the company. Even though you're not getting a dividend, you're gonna get more growth from a stock that doesn't pay a dividend typically, because they use that money to focus on growth. Whereas the dividend paying stock, you might not actually see a lot of growth from the stock. So it's gonna be a lower growth rate, but then you get that dividend to kind of sweeten the pot and help you keep that stock, because of course it's nice to get just paid for owning a stock. These dividends are paid typically once a quarter, and they'll announce ahead of time how much they plan to pay. Usually it's really in a certain range. For each company, it's very different. Sometimes it's 1%, 3%, 5%. It could be higher than that, but we'll get into the risks of that in just a minute. Now, when you get paid your dividend every quarter, you can choose to have it reinvested. So that means the money that the company pays, they just kind of put it back into the stock, which allows you for more compounding growth for your future. If you're using dividends as passive income, then what you would do is you would take the dividend and spend it typically, or buy more stocks maybe, but you're using that dividend as a form of income versus putting it back into the stock. So if you're looking for passive income streams, owning stocks that pay dividends could be a way to get that passive income. But keep in mind, you've got to have a pretty significant amount of money invested into any given stock in order for that dividend to actually be enough to provide you with income, meaningful income. Because if you get paid a few dollars once a quarter, it's really not going to move the needle for you, even if you get paid $10 or $20, right? But if you're getting paid hundreds of dollars and thousands of dollars, then it can really start to be something that is meaningful for you, that can start to pay some of your bills. If you've got less than $100,000, then focus on getting more money invested, knowing that the long-term goal is to have enough invested to where you can start pulling money from your investments and have that passive income stream. It could be a strategy that you employ in retirement, right? And you just set yourself up for success in having a dividend passive income stream. So if you're far from retirement, you've got less than 100,000, I would say definitely reinvest your dividends if you do have dividend paying stocks. Otherwise, they're just too small to even buy more stocks with, really. So if you just reinvest them, then it gives you more opportunity for those stocks to compound and grow over time to be something more substantial for you. Now, when you're looking for stocks that pay dividends, something that you really need to be aware of is if the dividend is too high. So this is a major red flag for you. If you see anything over about 5%, you get into that red flag territory, where what happens is sometimes companies, when they're under financial stress or pressure or going through a difficult time, they don't want you to sell their stock. So what they do is they compensate you a high amount. If you find something that's like 6, 7, 8%, usually the stock is going down in value. Now let's get into when you really shouldn't be using dividends as your main strategy. And we touched on it a bit. If you're far from retirement, you might be better off in a growth stock. So a stock that's gonna grow for you more than a dividend paying stock that has lower growth. The idea of dividends are great, but overall, we just want more money growing for us. Positioning yourself to the point where you can get more growth over the long run, and then possibly transition into dividend paying stocks that tend to be a little bit more stable, a little less dramatic. And the reason you don't really want to use those early on is because if you're just reinvesting the money anyways, you're taxed on dividends as income. So let's say you make $100, just to keep it really simple, and you pay 22% tax. Of that $100, $22 is gonna be taxed, even if you reinvest it. But on the other hand, if your stock grows 22% and you don't sell it, you don't pay any tax. So that's $22 more that are going to be available to be working for you and growing for you even more, because you're not kind of paying that tax as you go. And when you get to the point where you do decide to sell, so we'll just still use that $100 if you've got a 22% gain. So most people fall in that 15% capital gain tax rate. And if you do, that means you only pay $15 instead of $22. So over time, you can see you're going to pay a lot more in taxes if you're paying income tax rates versus capital gain tax rates. Take a look at this video if you do need help with income tax rates, because I do break that all down there. And if you're at that point where you're just receiving your 3 or 4% dividend, your stocks are probably a lot more stable than if you were invested in growth stocks. So overall, you might feel a little more secure in your investment strategy. But remember, you don't want to be invested in a stock that just keeps going down just because it's paying a dividend. So those are some general things to think about and consider as you are looking at using dividends as an income stream. It can be a great way to have an additional income stream, but there is a time and place for it. So think of your overall time frame for being invested, how much risk you want to take, the tax bracket you're in, and all of that, and see which one is better for you. You could do a combination of both, of course, having some growth stocks and some dividend stocks. Again, if you're just reinvesting the dividend the entire time, it might be better to be in growth stocks instead. Let me know if you have any questions at all. Take a look at these videos for some more investing help. Be sure to subscribe if you're new here, and I'll see you on the next one.